Good morning, everyone. My name is Cameron Gleeson. I am Senior Investment Strategist at Betashares. Welcome to today's discussion. I'm going to be talking with Tim Edwards, the Global Head of Index Investment Strategy from S&P. We're delighted to have Tim with us all the way from the UK today.
Good morning.
Good morning, everyone. And we're going to be talking about the US equity market. We're going to look beneath the surface to look at what's going on at a deeper level in that market. And Tim will be talking a lot about index investing. So I'm really looking forward to today's discussion. Moving to the next slide. If we just briefly, I'm just going to show obviously our disclaimer. This webinar discussion is intended for institutional clients, wholesale clients, advisors, is not for retail. If you are interested in today's topics, we encourage you to seek your own financial advice. And of course, we're running this on the GoToWebinars application, which you can use there. If you see that little toggle there, or the question mark there, you can click on that, type in any questions you have along the way. We'll endeavour to get to as many as we can throughout today's recording. And later today, we'll send a recording or a recording of this session. So if you weren't able to catch the whole thing, or some of your colleagues weren't able to make it, they should receive a recording of that in their inbox. Before we start, I'm sure that many of you will be very well aware of Betashares. We're very proud, custodian, shall I say, of the investments and the wealth of over 800,000 Australians. We have $28 billion assets under management, thanks very much to your support. And we've continued to expand out our product set. We offer asset classes across the range so you can build your portfolio in a really efficient, low-cost manner with 81 funds now available on the ASX. So we're going to start today's discussion by just talking about a couple of really interesting charts that myself and Tim were looking at with regard to US equities and US investor behavior. The first chart here we see is really a good indication as to what's driven US equity markets this year. If we look at the market capitalization weighted S&P 500 index, we actually see that while that's rallied to June around about 16.5% this year, so that's been a very strong run for the broad market capitalization weighted index in the US. That rally is almost entirely attributable to a very narrow band of stocks. And those stocks have been labeled the Magnificent Seven, the AI winners, and various other labels. But we see here the performance of those stocks. So, that basket itself has rallied by 60%. Some of those individual names include Nvidia, which is up over 200%, Meta, which has rallied by around about 160% this year, as well as the stalwarts being Microsoft and Apple, which are both up around about 50 or 60% per annum. Now, this is somewhat of a turnaround from last year, when a company like Meta was apparently facing some challenges. But we've seen how the narrative around AI and how these companies have managed to sort of pivot and adjust their business models has led to their strong growth. What it has meant is if we look at the remaining weight of that S&P 500, so that grey line there, we can see it's actually been quite anemic in terms of performance. And in fact, to the start of June, overall had zero capital gains for the year. So that's certainly been very interesting, and we're watching that closely. Tim.
Yeah, I think I would add a couple of things. First of all, that's not hugely unusual in the short term, and even more so in the very long term. Markets go up thanks to actually quite a small selection of securities. So generally speaking, it's quite common that you've got everyone doing okay, but a couple of heroes that come out in certain industries or sectors. This year, it has been more extreme than usual. One, and secondly, what's unusual is it's also been what started as some of the very largest stocks that have done fantastically well. And what's happened as a consequence of this is that actually the US equity market has become relatively concentrated. And there's sort of two things that might happen here to reverse that. And behind a lot of what we talk about today, you should be thinking about these things. The first is, well, it could be that, the current situation continues, and we'll show you later some indications that perhaps the winds might be changing. Or it could be that those, what do you call them, Magnificent Seven? The Magnificent Seven may slow down in relative terms, and the rest of the market catch up. Or you could find the rest of the market actually really do pick up speed and catch up for different reasons. In both those cases, one would anticipate that a more equally weighted approach to US equities would do relatively well in comparison. And I think for those two reasons, plus the sheer fact of valuations, right? Those companies started looking relatively expensive,
yes.
And their share price growth has certainly outpaced their earnings growth so far. So you add that to the valuations, and you get to our second chart of interest. So we've had, S&P Dow Jones Indices have licensed a fund provider to offer a fund tracking the S&P 500 equal weight for over 20 years now, and the largest such fund is listed in the US. And this is showing you the shares outstanding in that fund, which has had 20 years of steady growth. But the interest has dramatically changed very recently. We've seen really strong growth over the past 3 or so years, and a real dramatic uptick in interest. And what's fascinating, especially about this, we talked about some of the reasons why this might be happening. One of the reasons we haven't talked about, traditionally, fund flows tend to be very positively correlated with trailing measures of performance. The last 3 months, the last 6 months, if something did really well, that tends to be the time when you see inflows. And conversely, if the fund is underperforming relative to its benchmark or to the S&P 500, that's often a period when you expect to see outflows. Title of the slide hints at the point I'm making here. These are really contrarian flows. When you have those 7 mega cap stocks doing really well and everyone else not doing okay, the equal weight index underperforms. And what I find thought-provoking about this is you're seeing participants in the US market acting in a contrarian manner. It's an underperforming asset, sure, but I think there are good structural reasons combined with valuation reasons why it makes sense. And I think now is what the market is telling you is that now is a really interesting time to look potentially at equal weight as a complementary or alternative to cap-weighted US equities.
Yeah. So we're going to have Tim, if you can just give us a bit of a background as to the S&P 500 equal weight index. Yep. I understand you've just celebrated the 20th anniversary of the index.
That's right. Yeah, we will talk a bit more about the 20th anniversary, but first, just for context, so what is the S&P 500 equal weight? How does it work? And it is reassuringly simple. So there are 500 companies in the S&P 500, and what the equal weight index does is it weights those companies equally. So they each get 1/500th of the portfolio at the rebalance, and the rebalance is actually an important part. If you build a portfolio and you allocate equally to every constituent, what will happen is some will do better, some will do worse, and you won't be equally weighted for very long. Once a quarter, it rebalances back to equal weights, and that's it. That's the equal weight index. It's reassuringly simple, but simple doesn't necessarily mean it's not a great idea. And in the 20 years since we first launched the index in January 2003, this remarkably simple strategy has shown really admirable performance. So this is showing you the first 20 and a bit years of its live performance, as compared to, so we've got the capitalization weighted S&P 500 on there. This list on the legend is ranked by performance. You've got growth, you've got mid caps, which is a proxy for slightly smaller than the S&P 500, small caps, the benchmark itself, and value. And the yellow line, which is the S&P 500 equal weight, has outperformed all of them, which I think is particularly admirable performance. So to kind of celebrate this and to write a letter to one of my favorite indices on its birthday, we actually did a special piece of research, and we published a paper which we called More Equal Than Others. If there are any Orwell fans in the audience, you'll hopefully get the reference, where we thought we would combine a review of equal weights performance with another of our brands, which hit 20 years of live reporting, which is SPIVA. SPIVA stands for S&P Index versus Active, and is the brand for a range of global reports that compare the performance of actively managed funds to indices. Now, our standard classic SPIVA compares actively managed funds to cap-weighted benchmarks like the S&P ASX 200 or the S&P 500. We did a special edition of this looking at the S&P 500 equal weight, and there are a few reasons why we thought that was particularly relevant that we'll get into, and we will go into the numbers a bit more. I just want to flag those rather striking numbers which we put on the front page of the reports. The writing may be a bit small, but over the 20 years of live performance, the S&P 500 equal weight index didn't just outperform other common indices in that middle point there. It outperforms 99.8% of all actively managed large cap US equity funds. That's 2 in 1,000 that managed to keep pace over that live period. So I'll take a few minutes and give you an outline of this paper, but I should say this is available for you to download for free. If you search the title, you'll be able to find it on your favorite web browser, and I invite you to read the details, but we'll share some summary highlights. So first off, why is equal weight a benchmark for stock pickers? And I claim that it is. It's a very insightful one, and the reasons are as follows. First of all, if you really strip down the essence of a stock picker, what do? Well, they start with a universe of eligible securities, and then they pick the ones they like. How can you tell whether or not that process is adding any value? Well, I would say a good starting point is to ask, well, what is the expected return from picking stocks purely at random? And there's, basic probability. The answer is, well, it's the average return among all the pieces. That's exactly how we calculate the return of the equal weight index. Add up all the stock returns and divide by a 500. So this is sort of one major reason why the equal weight index is a really interesting benchmark for the average stock picker, for factor indices, for all sorts of things like that. The second reason why it's interesting in this context is not so much a theoretical reason, but a bit more an industry reason. So the ability to avoid concentration in the largest stocks and the discipline of regular rebalancing are often ascribed as virtues exclusively available through active management. And you've probably seen where I'm going already. That is not exclusively available in active strategies. The equal weight index essentially encodes precisely those two things. And finally, it's not just a theoretical notion. The difference each quarter, each year between capitalization weighted and equal weighted versions of the S&P 500 is frequently material. So we're not just talking about minor tweaks in terms of return. It's often a material difference in performance, which kind of says, okay, well, this is something that potentially matters. So for those three reasons, okay, this is not just a purely academic exercise. There's an interesting application here. So that's the theory, if you like. Is there any meaning to it? And what I mean by that is, if equal weight is going to be a benchmark for stock pickers, you might want to see some sort of similarity in the patterns of returns delivered by active managers and in equal weight. And obviously they're all going to be US equities, so it's not really the overall pattern of returns, but the pattern of relative returns, outperformance, underperformance. And again, full details, read the paper, but here are the highlights. On the left-hand side, you can see the excess return on a year-on-year basis for the average large-cap active fund in the US. And in yellow, we have the equal weight relative return versus the S&P 500. And on the left-hand side, and then on a scatter on the right-hand side, you can see I claim and sort of hope to visually demonstrate, yeah, there's a similarity. When equal weight's doing very well, active managers seem to do a bit better. When equal weight's doing very poorly, active managers seem to do a bit poorly. And so there's something there beyond the theory. There's something real here in terms of a similar pattern of returns between active managers and equal weight. And I should stress here, the absolute levels are not the same, but there are similarities.
With that, I mean, that's sort of in terms of that similarity. I mean, do you put part of that down to, I think was your second point, are US active managers underweight large cap, or are they underweight tech?
Yeah.
Something commented on.
Yeah, I think so, and it does depend on the time period. So right now, and I know the stat for the top 5, or actually it's end of June, the top 5 companies in the S&P 500 accounted for roughly a quarter of the index. And if you are an actively managed, or if you're an active manager operating in large cap US equities, and you've put 25% in your portfolio in the same 5 stocks that make up 25% of the market, I think you have a hard time justifying your existence because that kind of exposure is available at very, very low cost. And so what we find is that typically, and they might choose different ones, but typically actively managed funds tend to be a little bit closer to equal weight than capitalization weighted when it comes to the very largest companies. So now that means that on average there will be a little underweight those magnificent 7. It also means as a consequence they'll probably be a little bit underweight tech, but obviously that's on average.
That's right. And you're going back like 15 years here. There were periods there where different.
Yeah, and they're not exactly the same, right? But there are similarities.
And the patterns are yeah, they're great.
Smarter viewers may have already guessed what I'm going to do next, because it says actually in the title, answer 1, yes, they look a little bit the same. That suggests perhaps that answer 2 might be that they don't look the same. So this is a reasonably short-term measure. This is just looking year on year. And where the differences become stark is actually when you move from the short term, or the relatively short term, to the long term. So again, just looking at cross-market averages, and now looking at 3-year, 5-year, 10-year, 15-year, and 20-year returns. So this is live returns for the equal weight index, and looking at the difference of annualized returns. And what you see is, while there are similarities in the short term, in the long term, over the past 15, 10, 20 years, 5 years, 3 years, you're seeing about a 2% difference in performance in favor of equal weight, and 2% or 2 and a bit % per annum over 20 years, you end up with an enormous difference in outcome. So yes, there are similarities in the short term, but in the long term, we're seeing really different outcomes. So this inspired, okay, let's roll up our sleeves. Let's really look in a bit more detail at active funds versus equal weight. And I'll present again, that was the paper, but I'll highlight some top level results. First of all, year on year, when do they do well? When do they do badly? So this is going back to 2004, looking at on a year by year basis. What percentage of actively managed all domestic US equity funds, so value funds, growth funds, big cap funds, small cap funds, et cetera, what percentage underperform the equal weight index? And what I invite you to draw as a conclusion from this exhibit is that most years, most managers underperform the equal weight index. We'll move from all funds to individual categories for funds, and most years to different time horizons in the next slide. But just to pass the observation on the way, in most years, I mean, look, it ranged, and some years were different than others. Some are 33, some are 95, but in most years, I know roughly 2/3, something like that, of funds were underperforming the equal weight index. Now there's a lot of information on this slide, and I don't expect you to take it all at once. I'll say again that you can go and find the paper, but this is looking at all the different popular fund categories, large cap growth down to small cap value and everything in between, and looking at those 3, 5, 10, 15, and 20-year performance statistics.
And should put out, these are US equity funds.
These are US equity funds.
But to cover all those different investment styles, the different size biases and the like. Yes, exactly.
And the sample size is in the thousands. So it's a rich data set. What I'd like you to take away from this is, if you look to the right-hand side on the 15 and 20-year categories, there is not a single fund category where less than 95% of funds underperform the equal weight index, and that is a 20 years, incidentally, in which concentration has actually increased in the S&P 500. So you might say the headwinds were against it, and yet fewer than 1 in 20 funds managed to even match it. So I'll talk a little bit, behind those numbers, and then we'll open up for a little bit more. First thing, if you want to understand what's driving those numbers, the first thing is that actually, in order to beat the index, you have to survive. You have to stay alive as a fund long enough in order to beat the index. And actually, unfortunately, the median outcome for a fund, an actively managed fund that was available 20 years ago, is it no longer exists. If you've underperformed, you might survive in the short term, but if you keep underperforming, you're often wound up and capital is returned to investors. Roughly between 2/3 and 3/4 of funds just didn't survive.
And on that, the ones that don't survive, do you have any stats as to what proportion of them were underperforming versus outperforming?
The vast majority.
Yeah.
The vast majority. It's very, very rare that an outperforming fund is retired.
Yep. Okay.
But okay, all right. What about of those that did manage to survive? Okay, well, here's the distribution, and this is sort of a histogram, if you know what that means, but it's showing you what were the returns among all those samples of surviving funds. We've identified the large cap funds, which are kind of home market for S&P 500 equal weight, and all the others in different shades of blue. And you can see here that, look, this wasn't an answer these are not statistics that were determined at the margins. Even if we narrow our attention to only those funds whose performance was good enough to give them a 20-year track records, they were, the vast bulk of them were a good solid 2-ish% under the equal weight index per annum. And I think this question, or this data point exhibit, helps also answer the question of like, okay, well, would adding an asset management fee, would adding a bit of tracking error, would adding a bit of slippage from tax or whatever, would that fundamentally have changed these results? And the answer is absolutely not. The average fund was 2% below, and only very few funds were above, and then not by much.
Right. So what you're saying there is, rather than comparing it against the index, if you were to assume that you were investing an exposure to the equal weight through, for example, an ETF or a fund that has costs embedded, the outcome will be the same. Yeah.
Change it. So those are the, I guess that's my highlight summary of what we found in the paper. We will be talking a bit more underneath those numbers, but yeah, I mean that's what the data says. It's very strong, it's very compelling, and we may get into them that there are reasons to suppose that the next 20 years might look very similar.
Okay, great.
Right, yeah. So the question that I guess we haven't addressed is what's going on, right? So we talked a lot about active funds and what they might be doing. Why is equal weight done so well? And there are a few different ways that I would address that. The one that I think is the simplest to explain comes back to what we were talking about right at the start, which is about the returns of a few stocks can be fantastic. So this is looking at that same 20 years of performance, and it's also a histogram. But in this case, what we're doing is we're looking at individual stock returns. So my sample universe is every stock over that whole 20 years that was ever a member of the S&P 500, and I look at what were those stock total returns over the period. Now, a stock can only go down up to 100%, and that's the first bar in the series there. 21% of stocks went down a little bit to 100%. Then you've got the bulk of the distribution, stocks that had a sort of 0 to 3x return. And then you've got this really long tail all the way up to 1% of securities that had 20x returns. Now, this is not just a feature of the past 20 years in US equities. We've run similar analysis for different periods for US equities. We've run similar analysis on Australian stocks, Japanese stocks, European stocks. If you go really short time periods, you may not see this, but if you move your time period out to 5, 10 years, you'll see something like this. There was an academic by the name of Bessenbinder that did a 90-year version of this for US equities.
Great paper.
And the name of that paper, if you want to go dig it out, it's a great title, Do Stocks Outperform Treasury Bills? And I think if I remember correctly, he showed that all of the returns from the equity markets over the past 90 years were attributable to just 4% of securities. Now, suppose that is something that continues in the future, or if you like, consider this as a perspective on what happened over the last 20 years. The stock market is a little bit like almost like a lottery in this sense. You have the median stock, 50% of stocks, and you can sort of see it virtually. The first two categories there add up to 50%. The median stock is way below the average, because the average is driven up by a few superheroes that have whatever it is, 20x kind of returns. Okay, so what should you do an investor by that? Well, you've got two options. Either you could say, well, I think I've got the skill set and the ability to identify in advance who those superheroes are going to be. And if you can, you are worth your weight in gold, genuinely, right? Because your returns are just going to be absolutely heroic compared to everyone else. But if you think that actually they're really difficult to identify in advance, then the important thing to do is to just ensure that you participate. Just ensure that you don't miss out on an allocation to those 20x's or whatever they are. And from a sort of game theoretic perspective, the optimal strategy actually is, well, I don't know which ones they're going to be, but I just want to make sure that I get my fair share of them. The optimal approach actually is to equal weight, not necessarily to put any more in one stock rather than any other. And a couple of years ago, we did a paper looking at the historical outperformance of equal weight. We called it outperformance of equal weight indices. We looked at not just the US, but a few other markets. And we ran an analysis to look, ex post, how much of equal weight's outperformance could be attributed to the fact that it had a greater allocation than the market in the superheroes. And what we found then, and if we did it again, I'm sure we'd find the same answer now, was quite interesting. It was a little bit qualified. So first of all, yes, that is what's driving the outperformance. However, there was one qualifier to that. The best performing stock over the past 20 years, when we did it then, and if you did it now, you get the same answer. It's actually Apple. Mm-hmm. And the capitalization weighted S&P 500 did have on average a greater participation in Apple than the equal weight index. But here's the qualifier: the returns of Apple compared to absolutely I think it was 100x the average or something like that. In terms of its return. If it did that again, Apple itself was going to be larger than everything else in the US economy. So I'm not sure it could do it again, but and of course we did go into other perspectives, sectors and so on, factors and so on. There's a small cap bias, there's a value bias, etc. But to keep it short and simple, I think this notion of greater participation in superheroes is a really important aspect of equal weight. And what I like about it is it just comes direct from the methodology. When we go back to what does it do? It just takes all the stocks and weights equally.
Yeah, I like the way you sort of explain that, using a mathematical background. I think that's really interesting. Like, I guess the way I like to talk about that is if you say, for example, the median return was say 6% on this chart here, and if you're a stock picker, like an active manager, and you are not going to hold the entire universe. And let's just simplify that down to, I'm going to buy one stock. I'm going to be a stock picker that holds one stock. Where is that stock most likely to land? And it's going to land in one of those, likely the two biggest bars there, which are obviously below 6%. So it's just a great explanation.
Yep, absolutely.
So we've got this chart here now. I mean, you talked about this, about the level of concentration. Maybe Tim, do you want to touch on this one?
Yeah, sure. So there's something really intuitive here. What does it mean when concentration increases? It means that the big things took up a larger share and the small things took up a smaller share of the overall capitalization market. There's a really intuitive connection between whether concentration is increasing or decreasing and the relative performance of cap and equal weight. And what this shows you is a 50-year history of that. So the shaded gray area is the weight of the largest 5 companies in the S&P 500. I think I mentioned at the beginning, we just hit 25%. You can see that here. You can also see that in a historical context. Essentially, we haven't been, from that measure, we haven't been at these levels of concentration since the late 1970s. Yeah, we have been here before. Not shown, but in the very late 60s, IBM was 10% of the US equity market.
Right.
But anyway, don't let me get distracted. You can see a couple of things. One is concentrations tends to ebb and flow over time, right? That grey series kind of has a mean reversion in it historically, and it's also very connected to the relative performance in orange, the line of equal weight versus cap weight. And I think this gives you two perspectives on why an equal weight index is interesting to look at now. The first is, in absolute terms, concentration is relatively high. And so that gives you a good onus to look at, ways you might want to manage that or diminish it just from a kind of risk perspective. And secondly, it has historically mean reverted. And when it mean reverts, that tends to be really good for, in relative terms, for equal weight. And lastly, I think where's this slide run up to? May 2023. Lastly, there are signs that this may be changing. And this is, I think, the final slide that I've contributed, but if we go on to the next one. So you can sort of contrast this with what we looked at the beginning. So if you ran from January the 1st to May 31st of this year, the S&P 500 was up a little under 10%. And there you have, the 10 largest contributors, and some very familiar names there: Nvidia, Apple, Microsoft, etc. They contributed positive 11% or so, and the rest of the market actually subtracted from returns.
Wow.
But the winds appear to have changed, right? And so if you then do the same analysis between June 1st and last Friday, those really big names, and they're the same ones that were the largest contributors, they've not started falling back, but their relative contribution has been much less. And in fact, all the others not just contributed positively, but their contribution was larger than the top 10 largest contributors. And so what you're seeing, initial signs of, potentially, it's early days, that's only a 40-ish, 42-day period, you are seeing signs of the rally broadening out to the rest of the market, and you're starting to see grounds, or potentially you're starting to see the ground being set for a stronger performance in relative terms from equal weight.
Yeah, that's interesting, isn't it? So yeah, great. So thank you very much, Tim. That was really, I think, some interesting topics. We'll come back and we'll certainly do some more questions. But I just wanted to talk for our Australian audience in terms of how they might look to get access to the S&P 500 equal weight. Tim obviously works for S&P, and they're responsible for administering that index. At Betashares, we offer QUS, which is the Betashares S&P 500 equal weight ETF, which you can see some of the details of that fund there. Management costs of 29 basis points per annum. And we see, I highlight a pie chart showing the sector breakdown in the middle of the equal weight versus that of the S&P 500 market capitalization weighted index. And the thing that's kind of clear to me, I mean, just looking at that wagon wheel, is the greater degree of balance in the equal weight index from a sector perspective. If we think about sectors as growth versus value, the largest sector there, industrials and say financials, the third largest sector being more towards the value side, and the second and fourth being more growth oriented. So automatically you've got something which is a little bit more balanced, and frankly, it's a little bit more like the S&P 500 index used to look like 5 years ago. So the market capitalization index these days, two largest segments being IT, healthcare, and then you've obviously got communication services, other growth related sectors dominating that index. So in a lot of senses, it's a more balanced exposure than the market capitalization weighted index. And I'll show here, we did see just before with some a few other exposures to US equities, but just a basic chart showing the 20-year performance of the equal weight index versus its market capitalization weighted cousin there, and that around about 1% per annum over that time period. Now, importantly, and I think we sort of touched on this, is if you look at the performance over the last 10 years, the market capitalization weighted index has outperformed equal weight. It's that generation of strong returns in some of the periods prior to that, which has led to this outperformance overall. The point isn't whether or not it's outperformed over the long time period. The point is, what's the setup look like now? And given that degree of concentration, I think it looks pretty good for equal weight. So, why would you look to use such an exposure? Well, we've talked about the concentration, that reversion in equity markets back to a more normal level of concentration. it's also an exposure which gives you a profile which is slightly weighted towards more of the mid-cap stock section of the US equity market. And those companies tend to have a greater exposure to the US economy in terms of their revenue versus market capitalization, which is more exposed to some, for example, emerging market countries. And then it gives you that sort of, participation in the broader US economic growth. But more importantly for Australian investors, and I've got a couple of slides here. If we think about the journey that a lot of us have been on over the last, say, 5 years, we know that a lot of investors have allocated to growth style exposures. And I show a slide here which uses our NDQ, our NASDAQ 100 ETF, which has been a very popular exposure and has performed incredibly strongly over a long period of time, including the last 6 months. Now, that's been a great exposure. But if we think about that from a portfolio perspective, what does the NASDAQ or indeed a lot of other growth exposures give us access to? Well, from a factor perspective, you're probably getting exposure to growth as a factor, to momentum, and potentially a large cap bias. What does the QUS exposure give you? Well, it's a smaller size bias. It's mean reversion, the opposite of momentum, and somewhat value oriented. So this can be really complementary. And if we look at the degree to which the NASDAQ and the equal weight move, they move quite differently. So we have an example here of if you were to blend the NASDAQ and the equal weight exposure, what does that lead you? Where does that lead you in terms of a profile? This is a 25-year time frame. And we can see the NASDAQ shown in black, the equal weight shown in light orange, and the blend of those two exposures, which frankly looks a lot closer to the NASDAQ in terms of performance. But because you're blending two exposures which have a relatively low degree of correlation, the volatility of the pair is much lower. And if we look to the bottom of that table, when we're looking at returns, we like to look at risk-adjusted returns. We can see how that risk-adjusted returns of the blend in the third column looks really attractive, versus these individual parts, but also versus the broad market. Similarly, we know a lot of investors have accessed, just broad equity from the US through the S&P 500 market capitalization weighted index. For those investors who might have invested 5 years ago, when the S&P 500 looked, frankly, a little bit different to where it looks today, if you want to bring balance to your portfolio, if you want to perhaps reduce some of that concentration risk, one way to do that is to introduce some S&P 500 equal weight exposure through QUS. And I show here the impact of blending those two exposures. So the market capitalization in gray, the equal weight in light orange, and the blend of the two shown in the middle. And we can see the impact on Sharpe ratio, on risk-adjusted returns there. So these are two, really great applications for Australian investors because we know where Australians have been, the journey they've been on, and some of the portfolio allocations they might have. How to use QUS to add balance to your overall portfolio. Now, of course, everything we've talked about today, risk is a big factor in terms of investing. There's plenty of information on our website with regard to QUS. We encourage you to read through that. And, just to note some general disclaimers, you'll receive this pack in the email from S&P there. Further to that, Tim, maybe it's important that we should really point to some of the research that Tim's done over a long period of time, which you'll be able to access through links in the file which we send you. But you can go to the Indexology blog. I think it's a great resource. I think S&P do some excellent work there in terms of understanding markets, looking at particular factors that are driving markets and different investing approaches. So there's a whole world of resources there. And I think you're really a thought leader in terms of thinking about investing globally.
Yeah, so I and my team have long been advocates for using equal weight as initially, we sort of made the cases, we repeated some of it here, it's a really useful benchmark. If you want to know if some factor, some manager is adding value or not, I really like equal weight as okay, well, can you be equal weight, right? Especially in periods when equal weight's done well.
Yeah.
And that's the first one on this. We call it raising the monkey bars. Could you beat a monkey? Is the notion there? Fooled by conviction argues against over concentrated portfolios and a few others there. We mentioned outperformance and equal weight, which is really drilling into factor, sector, stock perspectives on what's going on. The concentration within sectors was actually looking at. We mentioned the ebb and flow of concentration. a lot of that actually plays out in individual sectors, where you think, you know, there are certain industries where a leader comes to dominate their sector, and then that creates an opportunity for, you know, everyone else to come after and catch up, and so a lot of the dynamics of that concentration, ebbing and flowing, are actually playing out in sectors. We talked about that, and as you mentioned, the Indexology blog is a great resource to just kind of see what's the latest and greatest at S&P.
Great. Okay, so now we've got some questions that have come in. So maybe I'll start off actually with one from me, if that's okay. Just if you can talk about the underlying drivers. So you talked about obviously the skew, but maybe can you talk about the drivers of the equal weights outperformance?
Yeah, certainly. So I can give you a sort of short summary of what we did in that outperformance paper. So we sort of looked at sectors, we looked at factors, we looked at individual stocks, which I mentioned in terms of that skew. From a factor perspective, it's really pleasingly intuitive. So if you're comparing capitalization to equal weighted performance, what do you expect to see? Well, so first of all, you expect size to be a factor, right? So the equal weight index on average is going to hold smaller securities. So that just on that explains about 50% of the overall variation in returns. So that's pleasing. The second thing is, what else does the equal weight index do? It rebalances. What happens when you rebalance? Well, you have to sell things that have done really well recently, and you have to buy things that have done relatively poorly recently. That's an anti-momentum mechanic, or a mean reversion mechanic. So once you've explained, you know, half of it from size, you can explain half of what's left through the anti-momentum factor, and then, you know, okay, well, what's left? Well, you're only really trying to explain 25%, and some of it's complicated. But the other thing that you will expect is what you already expect from going smaller size and anti-momentum, so value, right? Smaller companies that have fallen in price, so there's a value component there, and there's a few others. From a sector perspective, and this one, I have to confess, when I did this analysis myself the first time, this surprised me, because what you will see if you look at equal weight and cap weight is you will see that the equal weight had a lower allocation to technology in the late 90s and in the tech bust. The equal weight index had a lower allocation to financials in the 2006, 2007 run up, and through the 2008 crash. So I was expecting sector bets to be a big part of what was going on in the performance. What actually happens in the data empirically is that, yes, you know, it had lower allocation to tech, but it missed the run up and it missed the decline. Lower allocation to financials, it missed the run up and missed some of the decline. Actually, from a sector perspective, nearly all the extra return came not from the sector allocations, but from equally weighting within each sector.
Right.
And that observation actually was kind of the genesis of, okay, well, let's drill into this sector concentration and what's going on there. So I mean, it's all there, and over shorter periods, actually, sector biases.
I was going to say, over short periods, you
are really going to explain a lot. Just in terms of the long term, we found out that they were cancelling out over the long term, and it was about equally weighting within each sector.
Yeah, great.
And actually, can we take? There was a question there about, and you mentioned 10-year performance. Can we go to? I'd like to. This may be helpful for the audience, but yeah. So you got sort of 10 years underperformance. Okay. All right, let's dig into that a little bit. So as I mentioned, and we've talked quite a lot about concentration, and hopefully the audience feels comfortable that there's a connection there. It's not all there is to it, but there's a connection there. So look at the last 10 years. So 2013, near the right hand of that chart, because it's a long-term statistic, 2013 was actually a low in concentration. 2013 was essentially, you can pick the starting point. People started talking about FANGs in 2014, 15, 16. And 2013 was the starting point in a concentration cycle. So the fact that yes, equal weight versus cap weight, it's underperformed a bit over the last 10 years. I think actually this puts it in a really useful context. It's actually surprising that it only underperformed by as little as it did.
Yeah, right. You can just see it on the chart, like, you know, that run up in concentration through there, but the drawdown in the orange line.
Yeah, it's relatively not that bad, right? Yeah, so it's there are additional sources of return beyond just ebbs and flows in concentration. But when you're looking at this index, yeah, right now the 10-year mark, it's kind of it's a challenging one, but it's challenging for really good reasons.
Yeah.
There's a dynamic there that's important.
Great. So maybe just to touch on a few areas, like you do a lot of work with SPIVA, active managers, their underperformance that we see through SPIVA. Is that just fees?
It's not just fees.
Okay.
Although in some markets it is. So if you narrow your attention to you move away from US large caps, move away from equities entirely, and turn your focus onto market segments where there is very little difference between one selection and another, right? So if you're, for example, looking at intermediate sovereign bonds,
okay,
right? There's not going to be a huge difference if you buy one bond versus another bond.
Yeah.
Your performance before fees is going to be quite similar to the market. And actually, if people want to dig into this, we do a report called Institutional SPIVA, which looks at underperformance rates before and after fees. Doesn't make a huge difference in equities.
Mm-hmm.
Essentially, if you've outperformed before fees, you will probably, I mean, at the margin there's differences, but that's not what's driving the numbers. But there are other market segments where actually fees really are the main driver for underperformance, and they're more narrow in the sense of low dispersion and kind of everything doing the same.
Great. Another question here. How much money is managed passively versus actively in markets?
We don't know exactly. The statistic that you'll see most commonly is actually mutual funds, right? So I think it was a year or so ago there was some excitement because the total amount invested in US passive mutual funds caught up with that in US active mutual funds. So that's now slightly in favor of passive. The question of, okay, well, but what about of the total market when we add in institutional investors, retail investors, and so on? We do estimate it. We think we've got the best data on US markets, but our estimate is unfortunately vague. It's but with a reasonable degree of insight on who's paying us for data, who's tracking things passively, on their own. We estimate between a quarter and a third of US equities is passively managed, and we believe, as a matter of opinion, we believe that that's probably the market with highest degree of passive ownership.
Right, quarter and third. And so what's is there a point where so much money is managed passively that there is the opportunity to generate alpha when the markets become inefficient?
Yeah,
people sort of already argue that might be the case, but we haven't.
There certainly is. So if there was a market that was 99% passive, I might change tack and come up with this new idea of, well, I'm going to pick which stocks I own. But it's important to realize that the tipping point is much closer to, there's much more room for passive than you might suppose. And if there's time, I just explain really quickly why that's true. So prices are not set by ownership. Prices are set by trading. And let's suppose you're at 50% passive, 50% active. In order to continue to track the S&P 500 over the past 10 years, you needed a one-way turnover of about 3%. Make it 5% if you're going to reinvest dividends as well. Mm-hmm. So you have to turn over 5%. The active guys, well, they comprise there are some active managers who are really quite low activity, right? They pick what they like and they hold it for a long time. Warren Buffett's a classic example. You need to include high frequency trading shops in your definition of active managers who are turning over their portfolio, literally 10 times a day, the whole thing. If you look at the average among mutual funds, one-way turnover average is around 50%. I think the true average is much higher, but let's take 50% because we want to keep it short and sweet. So passive turning over 5%, active turning over 50%. When they're balanced in ownership, there's still 10 times as many active trades as passive trades.
Right.
So there's actually a lot more room to run than you might suppose. But that's if you take the notion, and I do, that the important thing was about price discovery and price setting.
Yep.
And what does that is trading, not ownership.
Yep. Great. Okay. couple of other quick questions here. One is how frequently does the equal weight index rebalance? That is quarterly rebalance back to its 0.2% for every one of those 500 stocks. There's also a question about explaining why, and I'm not aware of this index, but why a global equal weight index has underperformed market cap index. And I think just from the research I've read from S&P, I think that this phenomenon of outperformance of equal weight, it seems to exist across all geographical markets, but maybe can you comment on it? I'm not sure.
You have to be reasonably careful about what you equal weight. And I won't say anything about the competitors index, but suppose hypothetically you wanted to do a emerging market small cap equal weight index.
Okay.
Suppose, and actually the backtest might look great, but there's really high dispersion in emerging market small caps, meaning that every quarter you'll have a bunch of stuff that's fallen a massive amount, a bunch of stuff that's risen a massive amount, and you're going to have to do quite a lot of trading to keep yourself at equal weight. There's also a very long tail of very small companies. So while in theory the equal weight approach might look good on paper for a really wide range of markets, the implementation question of is there going to be enough liquidity for me to rebalance, is there going to be enough capacity for me to scale my investment, does become more important. I mean, these are more questions for the fund provider or the portfolio manager than they are for the index company. I mean, theoretically there'll be an index and here's what it did. But I think questions of capacity do start to become important when you move away from, I mean, it's the S&P 500 that we're looking at, right? So there is the scale, the liquidity, the capacity to properly implement equal weight at scale.
Great. Okay. I think we've run over time, but I found that really fascinating. I just enjoy listening to Tim and reading all of his research. I find it very insightful. I hope you have too. And we really appreciate your support at Betashares. We hope you found this information valuable. If you're after any more information, I think we've included links to those papers that will be in the slides that are sent to you, or visit the Betashares website. If you look under our insights page, you'll be able to find some blogs and some insights we've put out on QS and this dilemma in US equity markets. And you can find more information about the fund by searching under funds on that website. Thank you very much for joining us. We hope you have a great day.
Thanks, Cameron. Thank you.